Alright, so you've chosen a broker, you've funded your account, you've done your DD. Wait, what's that? You don't know what DD means? Well, then stick around, because the stock market is filled with all sorts of acronyms and slang terms, some official and others not so much. Let's get the official stuff out of the way first. This, of course, is assuming you know what the terms buy and sell are. If not, then you probably should go brush up on your elementary school. Let's get two simple ones out of the way first. When a stock is increasing in price or rising, it is considered to be bullish. When a stock is decreasing in price or tanking, it is called bearish. Alright, now that we got that out of the way, let's discuss some buy and sell orders. A market order will buy or sell stock at the current price. This is useful for getting in and out of trades quickly, but it can burn you if you're not careful because sometimes the market moves quicker than your trade can execute, causing you to sell too low or buy too high. A market order will always execute on the ask of a stock if you're buying and on the bid if you're selling. A limit order, on the other hand, gives you much more control on where your order executes. When you set up a limit order, you can choose where you want to buy and sell. This is useful if you have a target price to sell a stock because you can set it up and forget it, and it will execute even if you're not watching the market. Similarly, if you think a stock is going to dip, you can set a limit buy order that will execute when the stock reaches your buy price. You will be using limit orders the majority of the time you're trading. In fact, some of the OTC market stocks can only be bought using limit orders because of their validity. Hold up. What about that bid and ask thing I mentioned earlier? Well, put simply, the bid is the lowest amount people are willing to pay for the stock at the current price, and the ask is the highest amount they're willing to sell for. In order for a stock to increase in price, the ask needs to be filled with new buyers, which in turn creates a new bid and ask spread as the price increases. Sometimes you will hear the term slapping the ask on stock message boards. This means buying at the ask price as opposed to the bid in order to keep a stock increasing in price. You might also hear the term bid whacking. This is the opposite, in which investors are selling into the bid, which decreases the price of a stock. Okay. So now that we know some core stock market terms, let's talk about a couple of the most important ones. The first one is called a stop loss order, or simply a stop. This is very important because it helps mitigate your losses on the stock market. It can be the difference between losing 10% of your money or 50% or more. Essentially, a stop is an order you place on a stock you own that will execute a market sell when the price reaches a certain point. So let's say you buy a stock for $1, hoping it goes up to $2, doubling your money. You set a limit sell at $2 in case it gets there, but what if the stock goes down? You can't always be watching the market. You're not a millionaire yet, you still gotta work. So, you set up a stop order at the maximum money you're willing to lose before you throw in the towel. 5 to 10% is a good number. So, you set a stop at 90 cents, and it turns out Slim Jimmy's ice cream stand isn't up to snuff after all, and it drops to 90 cents. Your stop order executes, and you get out of the stock with only a 10% loss. Not bad. Okay, but a stop-loss order is still a market order. Remember what I said about those earlier? How sometimes the market moves too fast to execute your trade? With this kind of stop, you risk the stock dropping even more before you can get out. We can remedy that with a stop-limit order. Picking up what I'm putting down here? If you've been paying attention at all, then you should know that a stop-limit order will wait until the stock reaches the price you set, and then it turns into a limit sell. So you set your stop at 95 cents, but then your limit sell at 90 cents. This means that if your stock hits 95 cents, then your limit order will kick in and try to sell at 90 cents or better. This can help guarantee where you get out of a stock. However, it can be risky if the stock is dropping fast because your limit price might get skipped over, negating your stop loss, which means if the stock continues to drop, you're going to have to make a quick decision whether or not to get out, or wait to see if it recovers. Because of this, I recommend beginners stick to regular stop losses. So that wraps up this video on stock market terms. I'll be putting out a part 2 soon with even more terms you should know. Oh yeah, I never told you what DD means. It stands for due diligence, which is somewhat of a universal term in the stock world. You will hear it all the time on places like Reddit and other stock message boards. Sometimes it means that someone has information about a stock, or they have DD. Other times, it's meant to imply that you should do your own research and make your own decisions before investing in a stock, as in, you should do your DD. If you got this far, I want you to comment, "Do your DD" below, and if you haven't subscribed yet, get on it!